Hello, everyone. How's everybody doing this evening here on the live stream? Thanks for being here. I know it's Super Bowl Sunday. We set things up to where, well, to be frank, I forgot. I totally forgot it was Super Bowl Sunday, and so we had things set up for 7 o'clock like we normally do. And someone actually left it in the comments on my Twitter feed, so we switched it to 4 o'clock. So I'm sure I'll probably have fewer people here. But for those who are here, thank you for joining me. We're going to get right into your questions. I've got some big announcements, though. And well, first, can everyone hear me on the audio? Looks like it's working well. If you can hear me, just put yes on the audio, or I can hear you, something like that on the feed, and I'll see it. And then just as a reminder, guys, if you've got a question and you want to make sure that I see it, just send a super chat. And I've got Sebastian on the phone. He'll text that to me in real time so I can make sure I answer it. If you just want to put a question in the live chat, just make sure you start by putting question in capital letters. And few things I want to go over, really important announcements. Number one is I will most likely cut back on the amount of videos that I do on YouTube to Monday, Wednesday, and Fridays. The reason for that is twofold. Number one, it takes a lot of my time to do videos every day. It's a lot of research. Believe it or not, I don't have all that stuff right buried in my mind. So I got to do a lot of research, and I don't want the quality. In fact, I actually want the quality of the videos to improve. So I think by doing them Monday, Wednesday, and Friday, they'll get even better. Number two is, and I was kind of debating doing this, but after what happened with Zero Hedge over I think on Friday, if you guys haven't been following that, Zero Hedge got banned from Twitter. So that, that you could debate whether that's good or bad all day long. I'm not here to do that right now. I kind of, if you want my views on that, I posted it on Twitter, and I'm going to be interviewing Chris with Quote the Raven tomorrow. We're going to specifically be taking a deep dive into the whole Zero Hedge situation. But that really prompted me to think and say, okay, I'm probably going to do just as much content, but move some of the content over to my my website. So that's the biggest announcement I wanted to make tonight. Is if you guys haven't already, go to georgegammon.com and just put your email in. If you go to the home page and just scroll to the bottom, there's a place there where you can submit your email address, and that'll put you on my email list. And the benefit to you is, starting off, is that on the videos Monday, Wednesday, Friday, they will go directly to you, so you don't have to worry about YouTube not notifying you. And I'm going to be doing just a couple quick paragraphs that will be exclusive content. We'll put the link to the video in the email, but then there will also be kind of a couple paragraphs where I describe, my thoughts behind the video and give you some more extensive insight to the video itself. And then moving forward, there will be unique content that we will only shoot out, whether it's a video or maybe most likely a video that I will not post on YouTube, that will keep exclusive for those people on the email list. And we'll be growing those bonuses moving forward. But the bottom line is, when you get done with the live stream tonight before the Super Bowl, just head over to georgegammon.com and put your email address in there. Okay, now let's hit the super chats. And just so you know, Sebastian, my chat is completely frozen. So we'll just have to work with it and focus on the super chats for right now. Okay, Emmanuel, thank you for the super chat. Asks, what would the first event in the chain reaction likely be if the Fed did in fact increase interest rates? What happens to existing bonds in the market? A price collapse? ? So, Emmanuel, it really depends on how much they increase interest rates. If they just go up maybe 25 basis points, probably not great for the market, but it's not a disaster. It most likely wouldn't be a disaster, especially on the long end of the yield curve. Uh, it's possible, but probably not too likely. If they go up to, let's say, 2.5%, then I think you're getting into a danger zone where, unless we've got a hugely inverted yield curve, it starts affecting a lot of different interest rates in the real economy, such as mortgages. And then it starts to, I think that's more what your question's pertaining to. And what we've seen in the past is when the 10-year gets above right around 3.2, 3.5, that's when the Fed has had to put the brakes on, and you've seen it kind of trickle down or out to the real economy. So I think there's a little bit of wiggle room the Fed has to go up, but it's definitely not the 500 basis points that they need to go down in case of a recession. And that's not based on their models. I want to be clear. I'm not saying that they just need to go down 500 basis points and boom, the next recession is fixed. Just based on their models, they say that usually to smooth out a recession, they need to lower interest rates by 500 basis points. Sven, thank you for the super chat. Sven asks, if an ideal economy with gold or Bitcoin standard with increasing value to your holdings, how do you still stimulate people to keep working and entrepreneuring? Well, I don't think that's going to be a problem. I think if anything, it would encourage the entrepreneurship even more because there's more of a benefit to accumulating savings, especially from the standpoint of, I think as human beings, we value the utility of our children's consumption more than we value our own. Therefore, if you just look throughout history and just kind of at your own situation or your family or friends, I think that there's a huge incentive for parents to make as much money as they possibly can, not just so they can buy an extra car, but so that they can provide a much better life for their children. So I think that it would actually do the opposite of that. Secondly, it's going to be very tough to squash the entrepreneurial spirit because people are always going to pursue their own self-interest, and especially with the way guys and a lot of women as well, but especially the way we're hardwired is we're always hardwired to improve, want more, and to take the next step. I remember when I first started making money, my goal was to make 10 grand a month. And I mean, I thought if I was making 10 grand a month, oh my gosh, all my problems would be solved. It would just be complete bliss. And then, of course, you guys know the story. Of course, then you start making 10 grand a month and you're like, after a couple months, you're like, okay, I'm bored now. What can I do to make 20? And you make 20, what can I do to make 100? And it just keeps going. So I think that's pretty common trait with entrepreneurs. And so I'm not too concerned with that. Now, once you get to a point, I think it can stifle it. If the tax rate, as an example, was at 60-70%, then I think but I think it would shift the behavioral, or it would shift the focus of the entrepreneur to another region before I think it would just stifle activity. As an example, if you took rates up to 60 or 70% in the States, the first thing it's going to do to guys and gals like me, entrepreneurs, is they're going to say, okay, well, obviously I can't do any business here because this is not worth my time. Where can I do business? And if that's XYZ country, fine, I'm going there. And I'm going to do whatever it takes to where this is just a problem that I need to fix. And one of the traits of a successful entrepreneur, they really need two things. Number one, you have to be able to manage people. Number two, you have to be able to solve problems and solve them quickly. And that would, as an entrepreneur, I would just see that as a problem that I needed to solve. And I think that's the way most would handle that. Okay, moving on. Tyler, thank you for the super chat. Says, I own a couple rentals in Mississippi already. I was thinking of trying to find a house hack in Seattle suburb if prices drop in order to diversify in another market. What are your thoughts? I think that's fantastic, Tyler, as long as you could get the house hack to be cash flow positive. And when I say that, I'm not talking about just a house hack that's completely dependent upon, let's say, Airbnb. So if I had a house hack where I had some sort of specialty location where I was charging $200 or $300 a night for my Airbnb, and that was part of this property, and that's how I was cash flow positive on the house hack, I'd be a little hesitant there, because if we go into a downturn, then that's going to put a lot of pressure on people's discretionary income, which will most likely affect the Airbnb rentals of those higher end properties. That said, if you've got a triplex out in, let's call it Olympia, and or Spokane or something like that, or around the Seattle area, maybe a little closer, but kind of on the outskirts where you can get a better RV ratio, and it's a fourplex or triplex, and it's just kind of, in a very nice neighborhood, good school districts, but it's more of a kind of a starter type of situation for a young family. That is what I'd be a lot more excited about. I'm not sure that you can find that in the Seattle area, but you're saying that if prices drop, then that's definitely what I'd look for. And I think that it would absolutely be something that I would look into. And just to be clear, you're buying cash flow, you're not buying the asset. So it's all about the cash flow from day one. Okay. Zedona, thank you very much for the super chat. Does the US really have a well understood monetary system? It seems we change the rules to suit our needs, and the current accepted system is just implied. Great show. If you're asking, is the monetary system understood by the vast majority of public? No way. Not even close. I would venture to guess the majority of the public doesn't even know what the Federal Reserve is. I'll bet you if I had one of those like Jimmy Fallon things where I just walk down the street of, call it San Francisco, well, maybe not, there a little more, but just call it like Las Vegas on the Strip, where I'm just interviewing tourists or something. And I asked them, what is the Federal Reserve? Not even what it does, but what is the Federal Reserve? I mean, how many of those people are going to get that right? Maybe, I guess, 20%. And then out of those 20%, how many people are going to know what the Fed does, or who the Fed, who Jerome Powell is, or anything? Unfortunately, the education level of the U.S. public as a whole, when it comes to the economy, the way the financial system works, or the way banking works, is just it's almost non-existent. And that's why I think channels like mine, or I'm sure a lot of people do just as good or better job than I do of disseminating that information. I think that's why it's just so crucially important. And hopefully this will reach more and more people. and more of the general public, not only in the United States but outside the U.S. as well, will increase their education level, their awareness, and be able to make better decisions as a result. Okay, Torbjorn, thank you very much for the super chat. Have you looked into any other countries in South America other than Colombia? Are any of them of interest considering the political risk, corruption? Well, first and foremost, the corruption is not something that I would worry about, because I think you got a hell of a lot more corruption in the United States. It's just in the United States that corruption is legal, and maybe other places it's not. And I'm specifically talking about lobbying or lobbyists. But even if there was corruption, which I think there's a lot of corruption everywhere in government, but it doesn't really affect the real estate market too much. I think what more so affects the real estate market, especially in a place like South America, is the fact that South Americans historically do not trust the banking system. They don't trust the currency at all. Therefore, and they're not real big fans of gold. I'm not saying that they don't appreciate the value of gold, but they like to keep their savings or their net worth in real estate. So a lot of people have asked me, well, George, what happens if the economy starts to deteriorate in Colombia, as an example? And I say, well, actually, if history tells us anything, for the first couple years, the value of the real estate in dollar terms, not just in local currency, but in dollar terms, would actually go up, because people are trying to scramble to get their money into something that they consider safe. And in the minds of South Americans, the safe haven asset is real estate. And you can also go back to when Venezuela started to run into a lot of their problems and see what happened to real estate in dollar terms. And it actually went up. Now, lately meaning last couple of years, the prices have gone down, from what I understand, in dollar terms, just because the crisis has gotten so bad. But for the first couple of years of hyperinflation, people were taking their cash and just putting it into any hard asset that they possibly could. And their default mechanism is real estate. So again, my point there is I wouldn't be worried about that. Also, there's very little debt in the real estate market. I read a study the other day that only 3% of Colombians have mortgages. That's not to say that 3% of the people that own homes, but 3% of the total population, compared to probably 40 or 50% in the United States. So there's just not a lot of downside risk when everyone owns their home outright. They don't have a mortgage payment, so they don't have to sell. What other countries? I don't know if there's any countries that I like as much as Colombia, for a variety of reasons. I mean, if you think Argentina is going to be cheap, you're dead wrong, because even though you've got a ton of buying power, from what I understand, most of the real estate's priced in dollars anyway, and it's going to just go up the more inflation that they have, to a certain extent. So I just don't see any place that I would like as much as Colombia. I wish I could give you some variety there, but that's just the honest truth. Okay, Peter. And looks like Sebastian's texting me questions. Yeah, Sebastian, again, my chat is completely frozen. So if you're going to have to try to send me some questions as well, in addition to the super chats. Okay, Peter asks, in one simple step, says step number one. That's funny. He's making fun of me doing step number 1, step number 2, step number 3. How do you think the economy will look in 10 years? Greetings, huge fan from Netherlands. I don't know how the economy will look in 10 years. The one thing I can say with a reasonable amount of confidence is inflation will be a lot higher than it is right now. Dollar will most likely be down, not in domestic terms and against and the DXY. That's what again, it's not a certainty. I would just say that the probabilities are very high. The Fed has backed themselves into a corner where they are going to have to print a ton of money if they want to continue to prop up this house of cards, especially if we get the coronavirus. And I'm doing a video on that tomorrow that makes its way over to the United States, and we start getting cities in the US that are on lockdown, like a lot of the cities in China, which is very possible. And I think the media, and I don't want to be an alarmist, but I think the media is really not understanding how contagious that virus really is. And again, I'll go over that on tomorrow's video and break down the math for everyone. But I think that if that, I don't want to say it's going to freeze the stock market, but if that creates an instant, and when I mean instant, I mean, let's say in a week, the market goes down by 15% or 20%, which I think is very likely, then what's the Fed's response? Okay, well, we know what they're going to do. They're going to drop interest rates to zero, just boom, overnight. And then they're going to start printing a lot of money. That's when they're going to do QE4, and it's going to be, they're going to actually have to admit that they're doing QE4. The problem is going to come in, the problem that could come into play is that if the market sees all of that stimulus and doesn't care and says, you know what, this coronavirus problem overrides the Fed's ability to print money. So you've got these cross currents, this tug of war. And over the past 10, 12 years, whenever the Fed has printed money, that has overridden everything else. Anything that was presenting a headwind to the market, that tailwind was so strong with all that money printing that it just blew away everything. I think if this coronavirus becomes that bad to where it overrides any type of tailwind that the Fed can provide by money printing, that could be the end game, if you want to call it that. That could be the black swan. That could be the catalyst that everyone has been looking for, or has been kind of assuming would come out of nowhere. That could be it, because the Fed would be rendered impotent. And if the Fed can no longer, or if their money printing no longer can prop up the market, then it's things get really, really ugly, because now there's so much systemic risk in the stock market with not only what's going on overseas, not only the derivatives market, but especially the corporate bond market. If you've got so much corporate debt that's right now just hovering on that line between investment grade and junk at triple B, if that tranche of corporate debt gets downgraded because they've done so many buybacks of their shares, so now their balance sheet is really, it's really skewed, and their numbers and results are more predicated on what's going on with their share price now than ever before, because they've bought back so many of those shares that are now on their balance sheet or that they own in house. And boy, if those shares go down, then they get downgraded, then they go from the triple B into the junk. There's no buyers for that debt in junk. the interest rates just blow out, and then it's a doom vortex, if you want to look at it that way, meaning that it's just a downward spiral. It's a self-perpetuating spiral where it just feeds on itself. The higher interest rates in the bond market create lower stock values. The lower stock values create higher interest rates in the bond market, and then that trickles out into pension funds, into consumer spending, in really into every facet of the American economy. And if you combine that with the fact with maybe some major cities being on lockdown mode, maybe flights being canceled within the United States, maybe Chicago, New York, San Francisco, LA, Dallas being on just total lockdown. That's yeah, but I'll dive into it further on tomorrow's video. And I'll actually go over the numbers and statistics. I won't just say, it won't be one of those things where you tune in and I'm just saying, oh, you got to be worried. You got to be worried. No. That's not what I do. This is not to be alarmist. This is to give you the facts as to what is going on, so you can determine on your own how much weight you should give this and what you should do to prepare. Either ignore it or maybe stock up on some food or something like that. I'll let you be the judge, but I want to definitely give you the facts and break down the numbers for you. Okay, Jeff, thank you for the super chat. Says stiff drinks for the Super Bowl. Yeah, the Super Bowl is not that big of a deal down here. I don't actually. Yeah, there are a couple places I could go watch it, but I don't know. I'll probably just. I've probably got a few more other things to do. But thoughts on owning trailer park in Houston? How to find? Give some free rent for their spot to serve on-site management. So I've never really taken a deep dive into a trailer park. I think that could potentially be a fantastic investment. The only thing that I've looked at and really come close to purchasing on that's kind of in the same area is I almost purchased a campground outside of San Antonio, Texas, at one of those lakes that it was this campground that had these cabins, and people would rent the whole cabins and drive down to the lake. And I was this close to buying that, and it fell through in the last moment. But I think it would be a fantastic investment to research. I don't have any real insights as to how to find good on-site property management or how to incentivize that property management. I think a podcast that I might refer you to is, number one would be Jason's podcast, the Creating Wealth Show. He's got over 1,300 episodes, and I'm sure he's got a few really awesome episodes on trailer parks. Another one would be the real estate guys and Bigger Pockets. So I'd go to those podcasts on iTunes and do a search. And with those three podcasts, I'll bet you're going to find some really awesome content that can help you make some good decisions. Hey, Kevin. Thank you for the super chat. Kevin asks, you've mentioned buying the miners as a great speculation. Do you see them shooting up with a stock market crash, or do you see them along with stocks this time around? So what's going through my mind right now is, if we get a big correction in the market due to this coronavirus, my guess is that gold will go up. And the reason, gold goes up for a lot of different reasons. Sometimes it's inflation, sometimes not, but usually the more predictable catalyst is uncertainty. And I don't think there's anything that could lead to more uncertainty than them meaning the government, locking down Chicago or San Francisco. So you'd have to assume under those conditions that gold would go up dramatically. And if gold goes up dramatically, I can't imagine that the miners wouldn't go up as well. And to be clear, if you watched, if you're looking at this just as a pure speculation, which would be my advice, I would also go back, Kevin, and watch that interview that I did with Rick Rule on Saturday. We posted the full hour interview, and we go into gold, we go into miners, and we go into silver as well. And silver, I think the silver miners right now could be an even, or in my opinion, I think as a speculation, that's even more interesting than the gold miners would be the silver miners. Same shirt, different day. Thank you for the super chat. Asks, do you know about First Amendment audits? I do not. I do not. But I can tell you that tomorrow I'm doing an interview with Chris from Quote the Raven, like I mentioned at the top of the live stream. And we're going to be diving into zero hedge getting banned and First Amendment. But then juxtaposing that to a private company or a company that's owned by private individuals having the right, as I totally believe they do, to ban or fire or do anything that they want. I had a couple tweets on over the weekend that, I don't know, they went viral, I guess you could say, where I gave my thoughts initially on the zero hedge ban. And I was talking about the principles. I didn't agree with it, but people really confused it. They confused it with me saying that Twitter doesn't have the right to ban zero hedge, which they absolutely 100% do. But just because I believe that Twitter has the right to ban zero hedge, it doesn't mean that I think they should. There's a big difference there. So and people had a hard time distinguishing the argument for the right to ban them and then the principles behind the actual ban itself. So my point is Chris and I will be talking about that in great detail tomorrow, and I'll probably post that interview over the weekend, or maybe that's something that I might save for the people that are on the email list. So I'll let that entice you even further to go to georgegammon.com and sign up for that email list. Hey, Tobias, thank you for the super chat. Really? Wow. That is fantastic news. I got to reach out to him. Let me write that down. Forgive me, guys. Let me read this for you. Tobias says Yaron Brook said he is interested in doing an interview. That is awesome. Sebastian, please write that down. And tomorrow, let's make sure that we reach out to Yaron via email to set up an interview. That's really great news. And on that note, I got some even better news today in that Marc Faber emailed me. And I emailed him the other day to request an interview. He emailed me back today and said that he'd be happy to do an interview. So we've got that set up for the first week in March. I know most of you are huge fans of Marc Faber. I know I am. He's one of those guys like Jim Rogers and Rick Rule, Doug Casey, that have just been instrumental to the way I look at not only markets and investing, but really the world around me. So that I was really, really excited to get that email from Mark. So good stuff. Okay, Dominic asks, I just saw something interesting. The copper to gold ratio is heavily correlated to the 10-year treasury. Any thoughts? Copper to gold. So copper. I would have to think that through to give you a good answer, Dominic. I'm assuming it has something to do with copper being such an industrial metal. So when the price of Dr. Copper is going down, you're going to see most likely, I would assume, the price of the 10-year going up. In other words, the interest rates on the 10-year going down. Not sure how that would play into gold, but that's I appreciate you bringing that to my attention. It's something that I did not realize, and I should look into that further. Funding Jim. First of all, Funding Jim, thank you for always being on the comments. I really appreciate that. There's a handful of people that are just constantly commenting, and it's awesome. I try to respond every time I see your comment or those people that comment all the time. I try to make it a point to reply, and it's. I want to be clear, guys, that on the back end with the analytics of YouTube, they don't show you all the comments. They only show you the comments that you can adjust it, but the main thing they do is show you the comments that you have not yet replied to. And even then, most of the time I don't see all the comments because there's just too many of them. So what I typically do is when I upload a video, I try to stay on for about a half hour and respond to as many comments as I can. So if you want to make sure that I see it, make sure you're there at 8 o'clock when I upload the video. But my point is, thank you very much. Great to see you here. Does buying in Medellin require all cash? For a gringo, it most likely would. You're not going to be able to get a normal mortgage. You could do hard money. My buddy Chris does hard money down here. He's been a commercial lender for a long time. That's going to cost you 12%, and you're going to have to pay it back in dollars. And probably the max on that term is going to be 3 years. So you can use it to give you a little bit of wiggle room, but you're not going to be able to get like a 15, 30-year mortgage down here. Jason, thank you for the super chat. Interview with Juliet DeClercq. I think that is a fantastic idea. I am a huge fan of Juliet. And one thing I've got to say, just so you know, Jason, is I met Juliet last January up in Vancouver when I helped Eric I helped him produce the Macro Voices live event. And that's where I first met Brent Johnson. And that's how I was able to set up that interview the other day. And I've got her on my list. And just so you know, she is a wonderful, wonderful person. She is so cool. Really, really a great gal, as well as just being one of the sharpest minds in the macro space. And she's got a little bit different view than the Rick Rules and the Luke Gromans and the Brent Johnsons. So I'm definitely going to try to get her on 100%. Arthur, thank you for the super chat. Asks, what silver or gold stock would you recommend? I'm not sure I'd give you a specific recommendation, Arthur, because I don't know why you're buying it. I would assume you're buying it for a speculation, but there are a couple of the really solid gold miners that I noticed have been giving a dividend yield, which would be a neat way to kind of more consider them an investment. I know Rick, if you listen to my interview with Rick, he was saying that over the last couple of years, because the price of gold has gone up above what their production costs are, some of the miners have been able to throw a lot of that cash back to the shareholders, which is where it should be going. And so I'm not really sure. I tell you what I will be doing, though. Part of my rationale for just doing videos Monday, Wednesday, Friday, and then doing the interviews like I have been on the weekends and the live stream. So I'll still be doing content 5 days a week, but not on Tuesday, Thursdays. And to be clear, that's not because I'm cutting back on the amount of content that I'm doing. I probably didn't make that clear at the beginning. I'm going to be producing just as much content, if not more, than I was producing in the past. I'm just moving a lot of that content over to the website, to georgegammon.com, and over to the email list. So my point there is that one of my goals for this year is to start disclosing my personal portfolio. And so if I'm buying a gold stock, as an example, if I'm doing the research, I'm going to post my rationale and my research for buying XYZ gold stock, and then I'm going to buy it. I'm not going to, I probably won't disclose how much I buy for obvious reasons, but I'm going to put it up there, and you guys can just see in real time what my portfolio is, and then you can see why I purchased each asset in that portfolio. And my goal is to get more involved with the miners. The physical gold, I'm probably not going to do anything because you guys, that's pretty obvious. But more with the miners, or if I'm buying dividend, really awesome dividend paying stocks outside of the United States, that you might be able to get it at a steep discount where the CAPE ratio is low and you could get a nice 5, 6, 7% yield. I'm going to be going over all that. I'm going to disclose everything to you guys. So make sure you look out for that in the future, and you guys are going to be able to follow along with exactly where I'm putting my own money and follow along the reasons why I'm investing in XYZ asset. STP Trader, thank you very much for the super chat. Based on the Fed paying 2% on excess reserves, and that is IOER, interest on excess reserves, ongoing bank bailout, right? Basically, basically that. And I don't want to go off on a tangent here because I really could. But in doing research last week on interest on the excess reserves in the system, now it's up to 1.5 trillion. And just to give you some context, prior to the GFC, that would hover around 10 billion. So we've gone from 10 billion with a B to 1.5 trillion with a T. And yeah, you can do the math on how much of a subsidy that is to the banking system, especially the big banks. But then I thought about it. I'm like, okay, well, how much do they have in just normal reserves? And because we all know that they've got about 9 trillion in deposits. Okay, well, you got to dig deep on the Fed's website, and I'll be going over this in an upcoming video, but they've only got about 100 billion in reserves. So if now they've got 100 billion in reserves, and they're getting paid on not only that, but the 1.5 trillion, I mean, this is billions of dollars in just free money that's going to the Fed. And why are they paying interest on reserves and interest on excess reserves? Because of quantitative easing. And this is not George Gammon tinfoil hat guy saying this. This is the Fed. They have to pay interest on reserves and excess reserves because there is so much. Let me back up. Before the GFC, the way the Fed would lower interest rates is they go into the market, they buy short-term T-bills, and there would be more money, there would be more reserves that the banks would have to lend to each other. Therefore, the interest rate on that overnight lending would go down to supply and demand. Well, what happened is after the GFC and they started quantitative easing, they pumped so much cash into the system that it brought the natural rate of interest down to zero. And there was no way the Fed could have taken that natural rate of interest for the Fed funds rate above zero. There was too much liquidity in the system. So they had to pay interest on reserves to set a floor to the overnight rate. So this is another side effect that quantitative easing had. And if you want to get conspiratorial, which I don't think is too far of a stretch, you can say that quantitative easing could have been set up just as a direct profit stream for the banking system, not just to support them and to prop them up like Japan did, but to give them just a massive injection of not just capital, but pure profit. So let me get back to make sure, I went off on a tangent there. Let me make sure I answered your question as well as I could. Yeah, bottom line is yes. Not just a bailout. It's because a bailout would imply that they're just propping them up. They're just flat out giving them profit and massive amounts of profit. Look at JP Morgan. Why is JP Morgan just knocking the cover off the ball? In 2019, I think they had their greatest profit ever, and Deutsche is getting rocked. And I outlined this in my video, but it goes back to interest on reserves. I mean, out of that 1.5 trillion, how much do you think is JP Morgan's? I mean, let's be honest, 30%. I mean, I'm just I'm spitballing that. I've nothing to back that up, but just do the math. I mean, take your calculator, take 30% of 1.5 trillion, and then take 2% of that, and then take Deutsche Bank and then give it the opposite. So they've got, let's say they probably don't have near that much, but they've got billions of dollars in reserves, or we like to think they do, and they're being charged. They're being charged. So it's the complete opposite. So is it any shock that JP Morgan is producing record-breaking profits and Deutsche is going bust? No, and it all goes back to the central banks picking winners and losers. The opposite of capitalism, by the way. Okay, Funding Jim, thank you for the super chat. Says best channel on YouTube. Thank you very much. I appreciate that. Visiting Medellin to meet up soon. Very cool. We'll grab coffee and I'll show you the projects. Just Sebastian can give you a little tour around for sure. Daniel, thank you for the super chat. Upgrade to 4K vid. I'm not sure how I'd even do that. But Sebastian, write that down. How do we upgrade to 4K vid? I think actually, we use Premiere, and my editors, just so you guys know, are top shelf. I mean, they're proper television editors. So on our side, that's easy, simple. As far as how YouTube takes it and converts it when we upload it, I don't know, Sebastian. Why don't we look into that tomorrow? Out of equities now, when? Okay, so Daniel, if you're in the equity market, if I was in the equity market right now, if I was long stocks, and I had to be long stocks for whatever reason, or in cash, I would, and again, this has got to be just a speculation, and it's a very small portion of your portfolio. But assuming that's the case, what I would be looking at is the Fed reversing interest rates. Going back to Stan Druckenmiller, he's stated on many occasions that he's never seen the stock market go down substantially while the Fed was in a loosening cycle. Or they were dovish or lowering interest rates, only in a tightening cycle. So I would wait for that reversal in interest rates on the Fed's part, and that's when I would think about it. Or actually, now I'm thinking this through, And again, I don't want to sound too alarmist, but the coronavirus could really, really rock the stock market. And I don't want to give any investment advice because one, I'm not a professional. All you guys know that. I almost flunked out of high school, never taken a finance or econ class. But I'm just telling you what I would do if it were my money. I would probably get out of the market now, wait for the coronavirus to settle down, see what happens with that. And once that passes, then I would probably, if I had to, go back into those positions, and then I would wait for the Fed to start raising interest rates again, and then I would become a seller of equities at that time. Ike, thank you for the super chat. Want to buy a small country house on 1/10 of an acre for 60 grand in rural areas of San Antonio, Texas. Low crime, great opportunity. Since I'm 20, wow, awesome. And just starting out with this. Thoughts on Texas market on fixer-uppers? Well, out of any of the markets in the United States that I like as far as appreciation upside, and I want to be clear, that's not why I invest in real estate. I invest in real estate for the cash flow. But if I was looking at it from the other side of the coin, I probably like that area. I definitely like that area a lot. And that's right where I almost bought that campground. I wish I remember the name of that lake. It's that big, huge lake just about 45 minutes northwest of San Antonio. Anyway, now the one thing I want to caution you, though, is that if you're buying a small country house on an acre or 1/10 of an acre, that's going to be illiquid. So that's something that's most likely going to take you a year or two to sell, and that's if the market stays strong. And I do not like illiquid assets. I've gotten my butt handed to me on illiquid assets. But see, with this, you could rent it out. Yeah, I mean, as long as this was close to some sort of tourist attraction where you could rent it out nightly or monthly, I wouldn't be so concerned about the illiquidity. Where I get really concerned is with an illiquid asset that you can't cash flow. So you're stuck with it, and you've got all this money tied up in it, and it's not paying you to own it. So that's the best advice that I can give you there. But you're 20 years old. Congratulations. I mean, awesome that you're really getting involved in investing at such a young age. Corey, thank you for the super chat. With the massive amounts of market manipulation going on today from the Fed and criminal bankers, is our fantasy financial market to a new norm, or just never going down? No, Corey. No, it's, excuse me, guys. It's water there. No, it's the markets go up and down. There is no new norm. There's no, oh, we've hit a new plateau. And remember the last time that they said that? That was in 1929. Remember who was the famous gentleman that came out and said that, I believe he was an economist, that said like a week before the stock market crashed that they had we've achieved a new norm, that stocks are not going down. It's a new world. Same thing with the .com. Same thing with the housing. They'll never go down. It's history. It's, if you study it well, you'll see that this is nothing new. And when people start talking that way, that's when you know you should be cautious. So the market will 100% go down. I'm not saying it's going to go down by 100%, but I'm saying the probability of the stock market going down in the future at some point in time is 100%. There's no way. I don't care. There's just no way the Fed can do anything about that. There, at some point, it's going to happen. The market is always going to be stronger than any central bank, and I think a lot of people forget that. Now, as far as when, nobody knows, and that's just we can only guess, speculate, and try to adjust the probabilities based on the current information that's at our disposal, and then use that to prepare for whatever we think is the most probable outcome and adjust your portfolio accordingly. Okay, so Sebastian, okay, thank you. I was just going to ask you for a question because my chat stream is frozen still. So MJ asks, do you think with the inflation that is coming that real estate prices will go up or down? You've got to rethink that question, MJ, because it's a great question, but in terms of what? So will real estate prices go down in nominal terms or in real terms? Because if we have 10% inflation as an example, and real estate prices go up by 5%, real estate prices have gone up in nominal terms, but in real terms, they've gone down. So you've actually lost purchasing power. And there were times throughout the 70s where that happened. Now, to be clear, real estate pretty much kept up with inflation, and I think over the whole decade of the 1970s actually exceeded inflation. So it would have gone up in real terms, but that was starting at a very low base. If the 1970s had started out with real estate prices at the same level as 2006, would real estate prices have gone up in real terms by the time we got to 1980? I doubt it, because there were times in the 70s where real estate declined in real terms. So that's the real question, or that's the best way I can answer that question is but you've got to first and foremost ask yourself whether you mean in real terms or in nominal terms. In nominal, and then you have to ask yourself, okay, can we have price inflation, meaning consumer prices, and asset deflation at the same time? And the answer to that is unequivocally yes. We look at 2009 or the last crisis, and you will see asset prices going down substantially. Housing went down nationally on average of 50%. But if you look at the CPI, which, as we all know, is lowballs consumer prices, the CPI for an entire annually did not go down. It actually went up. So you've got to kind of compartmentalize the inflation and the deflation in your mind to try to see how that plays out. I mean, I could see 1970s type inflation while at the same time the stock market and the housing market goes down in nominal terms by 20, 30, 40, 50%. Now, I think that if we had inflation over 5, 10 years, that the market and the housing market would come back to reflect that. But to think that we couldn't have a year where the market or just crashes like 87 or a 2009 during a time when we have 1970s type inflation, I think that's a very, I'm not going to say likely, but I think that it's definitely I would say that there's like a man. I'm trying to give you an exact number. I'm not going to do that. But it's definitely something that you've got to factor into the equation and really give it some thought, because it's something, especially with these asset prices just at sky high levels. It's something that we could see in the future. Okay. Daniel, thank you for the super chat. Asks, can property crash like it's 2008? 100%, Daniel. Yep, for sure. I mean, to expand on that a little further, you've got to look at a chart of historical home prices adjusted for inflation going back to however far back you can go. And you'll see that the prices, and again, there are areas, pockets that I like, but for the most part, especially when you look at the coasts, real estate prices are as high, if not higher, than they were in 2006. So, is there anyone among us, or even your friend and family member Fred, that would say that the real estate market was not in a bubble in 2006? Would anyone say that? I doubt it. But yet somehow prices can be even higher today than they were back then. And friend and family member Fred is saying that we're not in a bubble. That, like, how do you work that one out? So my point is that if we are in just as much of a bubble now in a lot of markets as we were back then, why can't prices drop as much, if not more, in those markets than they did in 2008, or between 2008 and 2012? Hey, Jill, thank you for the super chat. Asks, or says, looks like she's got a mortgage. Okay, mortgage free and clear rental property to buy new primary resident. Mildly cyclical market. Okay, current primary becomes new rental. Rates good. Real estate prices bad. What do you do? If I could just wave a magic wand, Jill, I'd try to figure out what the RV ratios are. And if the RV ratios were like around 0.5, 0.6, I would take that equity and I'd move it over into a more cyclical market. I'm sorry, a more linear market that had better RV ratios. And I would not only rent out, I would probably just rent your primary residence. Now, if you don't want to do that for whatever reason, not a lot of people, it makes them feel comfortable to own their own home, then assuming the mortgage is a 30-year fixed rate loan. Yeah, but I mean, I don't really know why I would I would mortgage the rental to buy the home. I would just take out another loan on the home. I don't really see, I don't see the rationale for doing that, because you've got free and clear equity in the rental. Yeah, I don't know why you'd want to borrow against the rental as opposed to the house. So maybe there's a reason that you want to do that I'm just not seeing. But the bottom line is that if you're at like a 0.5, 0.6 RV ratio, I'd rather have that equity in another market and just rent my primary residence. Okay, Robert, thank you for the super chat. Asks, can you have Trace Mayer on your show to talk about Bitcoin, investing, and economics? Alex Saunders was not a very good crypto expert, in my opinion. I think Alex is, personally, I think Alex is as sharp as they get. But I'm not sure who Trace Mayer is, Robert. I'll definitely have more Bitcoin experts on. And maybe Sebastian, if you want to write down that gentleman's name, we can look him up tomorrow and maybe reach out. Derek, thank you for the super chat. Asks Jim Cramer. All I have to do is read that name and I start laughing. Jim Cramer says, sell oil stocks. Time to buy. Well, I think that if you're using him as a contrarian indicator, you're probably going to get things right more often than not. More often than not, Derek. That said, assuming that you're looking at this as a speculation and it's a small part of your portfolio, what would I do? I would and also I'm assuming that this would be a long-term hold for you. So you're betting that oil prices will be higher in, let's say, a year, 3 years, something like that. How would I do this? You know what I do, Derek? I would look at the R naught ratio, and it's R0. They call it an R naught ratio for the coronavirus. This is something I'll be explaining tomorrow on my video. But what that is basically is the technical way to look at how fast a virus spreads. So if something has an R naught value of 1, that means that that if a person is contagious, they will most likely spread that virus to one other person. So, and if you get an R naught value of under 1, then that means the disease is just going to kind of play itself out, and we don't really have anything to worry about. At 1, it stays active, and at 2, then you start getting up into where it spreads pretty darn quickly because you have that compounding effect. It's like taking a penny and doubling it every day for a month. You get like $1 million or some huge number like that. So it's the same thing with these with the viruses, in the sense that if it's very contagious, you could have 100 people that have it at the beginning of the month, and literally 1 billion people that have it 30 days later. And I'm not saying that the coronavirus is in that category, and I'll go over the specific numbers tomorrow. But right now, the R naught value, they're guessing, and I'm just looking at papers that have not been peer reviewed. So this is take that for what it's worth. But they're guessing that the R naught value, initially they thought it was around 2, which was close to SARS, but now they're thinking it maybe around 4. That's bad times right there. That's not good. So my point is that as far as an entry point into oil, I would look for the statistics for the R naught value to go down to where we most likely won't see an exponential rate of growth for the virus in not only the US population, but the world population. Once I saw that shift, then I'd say, okay, maybe now is the time to get into oil, because it's been so oversold because of all this fear selling. And now we know, based on that value, that things are most likely contained, and the news will only get better, and the market probably will not have factored that in. So, not investing advice. I don't know what the hell I'm talking about. I'm just telling you guys that if I was interested in pulling that trigger for my own portfolio, that's how I'd be thinking about it. Okay, the Argonautics. Thank you for the super chat. Hi, George. I love your videos. What do you think? How much of what you're talking about applies to Europe? I live here, and I'm a bit concerned about the doomsday scenarios you outline. I wish I could tell you that I'm more bullish on Europe, but I listened to a Macro Voices interview with Russell Napier that I would strongly suggest you listen to as well. I believe it was not last Thursday, but the Thursday prior. And they really get European centric on that. And he talks about how he thinks MMT is going to first come out in Europe. That's where they're going to try it. That's going to be the initial ground zero for MMT. You want to look at it that way. And he thinks that interest rates are going to spike, which would be good for the banks temporarily. But he also thinks that's going to bring on capital controls, which is not good. And if I'm in Europe right now, I would be trying to figure out how I can get some of my assets out of where I live and out of Europe, just in case they come down with capital controls. And I'm not talking about something that's going to happen tomorrow, but 3 years from now, you may see something like that because of these negative interest rates. It just crushes the banking system, and it's going to crush the economy as well, because the rate at which you're able to create more currency is dictated by the banks, the retail banks' ability to lend. And if they can't lend due to negative interest rates, it just and then you've got the central banks and their models saying that interest rates need to be a lot lower or more negative, and you've got the banks and the reality of the economy saying no, they need to be higher, not lower. And then the central bankers just putting their head in that Keynesian sand and just putting the blinders on and just saying no, it's like the monkeys with the thing like this and like this, and they don't want to hear reality. They just want to. They've got this cognitive dissonance around their models being accurate, because if their models aren't accurate, then that means that everything they believe comes crashing down. So I'm not really bullish on Europe. And I would, if I was in your position, I would think strongly about how I could diversify my political risk. But that's not to say that the people in the U.S. or in any other country, Colombia, I don't care where you are, if you've got to diversify your political risk. Even if you're in Singapore, in a country that you think is the most stable, amazing country on the planet Earth, you still have to diversify your political risk. Okay, Cam, thank you for the question. Says, how will demographics of baby boomers in the U.S. play into real estate in the next 10 years? Well, we don't know exactly, Cam, because that is one cross current of many. And it's like trying to predict the weather, in the sense that there's so many variables that you can only take an educated guess. So because we have all these baby boomers retiring, especially moving into like foster or like nursing homes and stuff, you could see a lot more supply coming onto the market. You could see a lot fewer buyers, because they just don't have the money, because they're not getting their pension, they don't have the savings, because the Fed has kept interest rates so low for so long. I mean, if you're someone who's retiring, think about the fact that the Fed has kept interest rates at 0% basically since 2009. So you've had over a decade of zero or almost 0% interest rates when you thought, or all of your financial planning was predicated around you getting 7%. That's a big delta, especially when you compound that. So that said, I don't think that the baby boomers are going to be retiring with near as much disposable income as they thought they were going to have. And if you combine inflation, if you add that into the mix, the way that the CPI is calculated and the GDP deflator, even if they're getting their Social Security, it's not going to have as much purchasing power, because the Social Security payments are tied to one of those inflation indicators that we know are extremely low. So if their Social Security is only going up at 2% and inflation is at 10%, that lowers their purchasing power even more. So I think they're going to be sellers, and I don't think they're going to have, it's not going to be as much demand either. So I would say that's going to be a headwind for real estate moving forward. Okay, Leverage Local asks, what do you think about using infinite banking concept to invest in income producing property? I've heard a lot about that, but I've never really researched it. I know a guy that I respect tremendously talks about that all the time. His name is Bob Murphy, and he's a tremendous Austrian economist, a libertarian guy that does a podcast with Tom Woods, who's another one of my favorites, called Contra Krugman. And if you go to Bob's podcast, he's got several episodes on the infinite banking concept. I would start there, and then I would see how much sense it made to your personal situation. And then if you do think it makes sense, then I would just apply the principles of investing in income producing property that I talk about, or that Jason talks about as well. Jason Hartman, for those of you who don't know, just check out all the videos I've done with him, or go to his website at jasonhartman.com. Connor, thank you for the super chat. Asks, just want to say thank you for the fantastic content. I appreciate that, Connor. I really sincerely enjoy creating this content, and I know the whole team does as well. And it's really just quite an honor that people choose to support the channel through their time in not only watching the videos, but taking time to tune in to live streams and to comment on the videos. It's really amazing. And I just want everyone to know how much I appreciate it, and everyone else on the team does as well. Daniel, thank you for the super chat. Says, love your whiteboard. I now use whiteboard paint on my own wall. Doom Vortex is my new Oh, that is good. That is comical. Daniel, thank you for sharing that with me. That's funny. I'm going to get a kick out of that for the rest of the night. So let me finish what Daniel's saying there. He says that now his new password is that he uses, I'm guessing maybe for his email or something, is Doom Vortex. Oh, that's awesome. Can the Fed actually push negative rates? And how does this affect other countries' dollar-denominated debt? Daniel, this is an incredibly good question that I hear no one talking about. Nobody. And as a result, I'm definitely going to be doing a video on this in the next couple weeks. But people assume that the Fed can just make interest rates go negative. Not really. Not really. That's I think that's an inaccurate assumption. If you look at the way the plumbing actually works, and you may say to yourself, well, George, that's crazy talk. Look at how easy they did it in Europe and Japan. Oh, that's right. But it doesn't mean that the European system and the Japanese system works the same way. There are slight differences that at the surface may not seem like a big deal, but once you start thinking through this, how it actually plays out in the real world, they might not be able to do it unless they just printed so much money that they just bought everything on the yield curve. So why do I say this? Because they can take interest on excess reserves down into negative territory, but that doesn't necessarily mean that the short end of the yield curve will go negative. Just because the Fed wants interest rates negative doesn't mean that the market is going to be willing. And I'm not talking about the mortgage market or anything like that. I'm just talking about the overnight market and the dollar funding market. It would put downward pressure on rates, but I don't know that in and of itself would make rates go negative, because what you're doing is you're introducing IOER is putting a floor on interest rates, but it's not putting a ceiling on interest rates. So just because the floor on rates is negative 25 basis points, that doesn't mean that the ceiling would be. So then the next question becomes, okay, George, well, how are they putting a ceiling on interest rates right now? So if Fed funds target rate is, let's say, 1.5 to 1.75, well, how are they keeping rates at 1.75? Well, we saw what happened in the repo market. That didn't work too well for the Fed. It not only went past what their current top line for Fed funds when the repo spiked in September 17th was 2.25%, and the repo took the Fed funds up to 2.3%. So we know that without Fed intervention, that they can lose control of that short end of the yield curve regardless of where IOER is. They don't have as good a control over the ceiling as they do the floor. And technically, the way the plumbing is supposed to work is the discount rate is supposed to put a ceiling on that number. But what in practice, it doesn't really work that way, because as Jeff Snyder has pointed out countless times, that although technically a bank can go to the discount rate to borrow money from the Fed, no bank ever would, because it would be the kiss of death, because the entire market would know that if XYZ bank went to the Fed to borrow, that means they can't borrow in the repo market, or they can't borrow anywhere else at what would most likely be a lower rate of interest, or even if it wasn't, that no one else is willing to lend to them, and they're done. It's a self-fulfilling prophecy. So the discount rate really doesn't have all that much power to create a ceiling. So I know this is a long-winded answer, but I think it's very important that people realize that if the Fed wants to take rates negative on the short end of the curve, it's not as easy as just Jerome Powell coming out and saying, yep, we're taking rates down to negative 50 basis points. They could take IOER down there, but that might not work. I'm sorry, and I forgot the last part of the question here. How does that affect other countries with dollar-denominated debt? I don't think it directly affects those countries. Indirectly, you could assume that the dollar would most likely go down. Therefore, that would ease up some of that pressure on countries that had a lot of, or entities in other countries that had a lot of dollar-denominated debt. But it's all relative. So as far as the currency game, so that depends on the DXY. Stranger things have happened that they take interest rates negative, and maybe there's just such a flight to safety that because of like the coronavirus, that everyone's piling into dollars because of just a rotation into something that is perceived to be a safe haven asset. That meaning U.S. dollars. That would take the DXY higher. That would make their debt load more of a burden. But most likely, especially if the Fed's expanding their balance sheet at the same time, the DXY would go down. But it's not a certainty. Carlos, thank you for the super chat. Asks, he is from Portugal. I've got 110,000, I'm assuming euro mortgage, and an interest rate of 0.12%. Wow. Whoo. Boy, I hope Jason isn't watching this live stream right now, because he would fall out of his chair. Oh, wow. Good for you. Should I freeze the interest rate to 2/3% next 10 to 15 years, or should I wait? I wouldn't wait, Carlos, because I'd look at that like any other asset. And remember, and most of you know this, but maybe some of you still haven't heard me say this. You never want to ask, is the price going up or down? You never want to ask that question first. That should be way, way, way down your list of questions. The very first question you should ask yourself when you're thinking about buying an asset or taking on debt is it cheap or is it expensive? If it's cheap, you buy it. If it's expensive, you sell it. It's literally that basic. And if I look at that, I'm saying to myself, historically speaking, that is cheap debt. So I'm pulling the trigger right there all day long. Could it get cheaper? Sure. But that's not what I'm trying to figure out. I'm just trying to determine if it's cheap right now. And that is that would for sure fit that category. Dynamite, thank you for the super chat. Asks, when are you uploading your next video, Jason? Should be pretty soon. I'm either going to do it probably next weekend, the weekend after. I have to look at the schedule when we posted the last one, but we've already got it done. And maybe next week we'll have Jason on the live stream. I know I talked to him the other day, and he's coming to Medellin at the end of this month to visit. So we're super excited about that, because when he's here, we're going to do a lot of content for the channel. And one thing that we'll most likely do is a live stream where he and I can answer questions. John, thank you for the super chat. You've mentioned investing in certain diesel pickup trucks. Yes. Sounds like fun. What are the stats on what you look for? Personally, I just focused on Ford's 1994 to 2002. And for the diesels, just 95 to 2002, because that's the year that they had the 7.3 Power Stroke, which is the engine that everyone wants. For the gas, sometimes on a 460, I'd go down to 94 if I got a really smoking deal. But I would prefer the 95 to the 97s. To be clear, with the gas, I didn't buy anything over 97, because on the gas, the only thing that people want is kind of like a collector's item. is the OBS body style, which is original body style. That's that squarish body style. That's what's really popular right now. So that's what I would hone in on. And I would just look for good deals off Craigslist where I could buy from a private party in a local market. And I'd only go into areas that didn't have any rust, like California, Oregon, Arizona. And then I would buy them, and I've still got some. I've still got over $100,000 worth of pickups in storage. But I would either keep them or I'd just have them cleaned up a bit, and then I'd put them on eBay. So what you're doing is you're leveraging that arbitrage between buying local, where there are very few buyers, and selling national, where there are tons and tons and tons of buyers, and pocketing the spread. And when you do that, trust me, there is a big, big spread. And what I'd try to do is I'd try to get them with under 100,000 miles on them, and a clean title, of course. You don't want, I wouldn't mess around with salvage titles, or even if they had an accident, like on the Carfax, I wouldn't mess with them. So clean Carfax, under 100,000, Ford, F-250s, F-350s. I wouldn't mess with the F-150s. And the gas between 95 and 97, and the diesel 7.3s between 95 and 2002. Graham, thank you for the super chat. Do you prefer physical gold or paper gold? I have silver coins, and I'm thinking of investing in gold coins, but it's 4 to 5% higher than spot. I definitely prefer physical. The only reason I would even consider buying paper gold, actually, I don't even think I would. I was going to say as a speculation, but if you're going to speculate, why not just buy the miners? Why would you buy like an ETF? And for me, insurance is got to be the physical, whether it's silver or gold. I kind of consider silver more of a speculation and gold just pure insurance, but it's to each his own. And I just physical all the way. But I think silver coins, I mean, that's a good way to go. And if you have to buy gold at 4% above spot, I don't like it, but I wouldn't be worried too much about it, Graham, because it's just an insurance policy. I don't care if my insurance policy goes up or down in value. That's not why I'm buying it. So I know it's tough for people to think of it that way, because if they buy gold at $1,500 an ounce and it goes down to $1,200, they're really stressing out over that. But in my opinion, if you're buying it for the right reason, that should be zero stress. It should be as much stress as you would have if your car insurance went up or down in value, and it wouldn't, because you're not selling or buying your car insurance on a constant basis. It's just there, and you've got it in case you need it. That's how I look at it. Victor, thank you for the super chat. How many weeks would it take? Wow, here's a Colombian-centric question. Very cool, Victor. How many weeks would it take to close on a finca in Guatapé? Do I need a lawyer and move money to a bank in Colombia? Thanks for the great consult. Okay, so, right, Victor. Now, I'm sorry, I didn't associate the name with our consultation. So you definitely need a lawyer, because a lawyer down here plays the same role as a title company back in the United States. So when you guys have a title company, they're the ones that are doing the background check on the title to make sure it's free and clear, there's no liens, and that's what you would need a lawyer to do as well. You'd also probably want to hire them to walk you through the entire closing process. It's not that hard once you learn how to do it, but for a first timer, you definitely want a lawyer you could trust to do that. And if you want to use our guy, just email Sebastian, and he'll give you our guy's name and contact information. And as far as how long it would take, that really is depending on the seller. Usually it's going to take 30 days, just like the States. But it all depends. Here, you really don't have to wait on the title company or any of that stuff. So you can close in 3 or 4 days if the seller's down. But usually it's going to take about the same time as the States. Moving money, you'd want to, well, I'm not going to tell you what to do, but I would suggest setting up an account with Allianza, which is the fiduciary that I use here personally, and it's the cheapest way to get paid to bring dollars into the country and exchange them for pesos. It's only going to cost you about 0.4%, where doing it through a bank would cost you 4%. So super cheap way to get money here. And if you want our contact there, email Sebastian. And I know the people at Allianza on a first name basis. I've done a lot of business with them. They know me extremely well. And Allianza is a huge company. Allianza Valores is the fiduciary's name. So if you want to look them up online to see what I'm talking about, make sure that you do that. But they're extremely well trusted. And Sebastian can give you the name of the of the people that I know over there, and it'll probably make the process a little easier for you. Okay, Christian, or it's either Christian or Christian, I believe is probably the right way to pronounce the name. Thank you for the super chat. First, thanks for your awesome work. You're very, very welcome. We really enjoy doing it. How do you manage your portfolio in the long run? For me, it's just always the same. It's 10%. You hit the nail on the head with the first one. 10% insurance, 10% speculation, and 80% investing. And that would classify as something that pays me to own it. That is excluding the cash. I want to be clear there, guys. That is just the portion of the portfolio that I have invested. So if I want to keep some powder dry, which probably be a good idea in this environment, then that is not included in those ratios. Would you, okay, in a couple years, 20%, 20%, 60%? No, I don't know if the time frame would make me adjust it too much. You might want to adjust it based on your age, and be a little more conservative. Maybe throw more of the money into gold. It is so dependent upon your personal situation. I just don't want to say do this, and if I found out about your personal situation, I would have said do the complete opposite of that. Would you sell 10% gold and 10% speculative assets to buy real estate? Again, it depends on how much cash flow that you need, but ideally no, because you'd want that diversity. And that's something that's just as important as everything else, is diversifying your portfolio and diversifying your political risk and your currency risk. Okay, cool. I think that is all we have for the super chats. We've gone over an hour and a half. So I want to thank everyone for joining me on the live stream this evening. I know it's a Super Bowl Sunday, so I'm sure you could be doing 100 other things with your time. I really want to say thank you to all the people overseas. I think we've had a ton of people from Europe. I really appreciate you guys being here. And just to reiterate, make sure that you're checking out the podcast. We take all the interviews and the live streams, and we're putting them on iTunes and Stitcher. It's under the Rebel Capitalist Show. and we're getting the downloads are really increasing on that. I think you guys would really like that if you're a podcast fan. And also starting this week, we're going to be doing videos on Monday, Wednesday, and Friday instead of all week, instead of Monday through Friday. We're not going to be reducing the amount of content, but we're going to be shifting a lot of the content moving forward to the website, which is georgegammon.com. And I would suggest everyone right now going over to georgegammon.com, adding your email to that list so you're getting notified of every video that we upload. And with the whiteboard videos, for starters, just to add a little incentive in there, I'm going to be, with those emails, I'm going to be including a couple paragraphs on certain insights that I had while doing the video. I think it's going to add a lot of value. And then moving forward, we're going to be emailing you exclusive content that you cannot find on the YouTube channel. So I hope everyone does that, and enjoy your evening. And I will see you guys tomorrow on the next video.